What's up, guys? It's Nick from Nick's Dividends. We got crushed by the market this week, but it provided some nice buying opportunities. Before we get into the content, please like and subscribe. On Monday, the market was closed for President's Day. Tuesday was one of my roughest days since the start. My portfolio was down about $353 or 2.13%. All major indices were down at least 2%. I'll start with the good news. AbbVie was up about 0.5%, and Procter & Gamble was only down about 0.1%. Were you expecting more? I hope not, because that's it. Pretty sad when I count a stock in the red on the day as good news. Luckily, I don't plan on selling anytime soon. The rest of the portfolio was down anywhere from 1.1 to 7%. Home Depot beat estimates, but due to losing customers and a declining earnings per share estimate for 2023, the market reacted negatively. We received a nice 10% bump on the dividend from Home Depot with a quarterly dividend raise of 19 cents per share to $2.09 per share. No major news directly for anyone else. Speculation appears to be related to the Federal Reserve raising interest rates by more than 0.25% at the upcoming meeting in March. Wednesday was looking like a good day at the start. We were up about $75. I didn't find out until market closed that I was actually down around $25 on the day. Most items were within 0.5% of what they started the day at. AbbVie and JP Morgan were both the worst, down about 0.8%. AbbVie appears to have had a ratings downgrade by Wolfe Research from outperform to peer perform, which just means they expect the stock to perform the same as its competitors. Only news for JP Morgan was it banning its employees from using the AI chat GPT at work, which is likely just for a security measure. If you notice at about 2 p.m. on all graphs, there is a reaction. This is when the Federal Reserve released the meeting minutes from the last Federal Reserve meeting, and this is just the market reacting to that report. Thursday was a decent day. Microsoft ended up 1.4% with news relating to AI and cloud computing. Home Depot was up about 0.8% with no real news. This is likely just the market rising a bit off the major drop on Tuesday. I have been trying to figure out what caused that midday crash, but none of the reports that came on Thursday make sense for the crashing things when they did. The jobs report came out pre-market, so I would have expected to see that drop at the open. The crude oil and natural gas inventory reports came out at about 10:30, which matches the time, but I wouldn't expect those to affect tech nearly as much as they did. On Friday, we got hammered again, but at least it didn't end up as bad as it did on Tuesday. We ended up down about 0.7%. The market was down because the PCE report came in with inflation higher than expected at 0.6% versus the 0.4% that was expected. So there is uncertainty about the next interest rate hike possibly being above the 0.25% that it is currently expected to be at. Jerome Powell mentioned they would get more aggressive if the inflation didn't continue to go down at the same rate. So we very well could see a 0.5 or 0.75% interest rate hike towards the end of March. 3M, Realty Income, Apple, and Microsoft all dropped anywhere from 1 to 2.2%. JP Morgan ended up about 1% higher, but as a bank, they will be just fine with the higher interest rates. On Tuesday, I purchased one share of Realty Income at $65.44 to bring us just above 16 shares. Then on Thursday, I was able to add another $515 to the account as the tax return finally came in. I know that I said $1,000 from the tax return, but I planned a vacation this week and used about half to book the flights right now. If you are at the World Series of Poker in June, I may see you there. Anyway, I added one share of Home Depot at $297.45, 2 shares of SCHD at $75.43, and one more share of Realty Income at $66.14. On Friday, I saw the market was down again, so I threw another $75 in and purchased one share of SCHD when I saw it had dropped to $74.34. Let's take a quick look at the dashboard. We are down about $457 overall, which sucks, but since we are in this for the long haul, I have faith that we will be fine with the positions we have. I plan to use the bonus money over time and average in. Yield on cost being below the dividend yield of the portfolio is not something we want to see, but it will improve over time as we average down into the positions, dividend raises happen, and the market goes back up. There were no ex-dividend dates or payouts this week, but as I mentioned earlier, Home Depot raised their dividend by 10% to $2.09 per share per quarter, which unfortunately doesn't yet show on the Google Finance, which is where the spreadsheet is grabbing its data from. We have crossed the $45 per month barrier, or $540 per year. If you include Home Depot's dividend raise, we are actually at $45.31 per month. Let's move on to talking a little bit more about Home Depot. The initial purchase was made when Home Depot was down about 20% from their all-time highs. Home Depot has a very limited competition, with their main competitors being Lowe's and to a smaller extent Menards. They are continuing to open new stores and have seen increasing profits in the last 5 years. Their payout ratio is decently low at 46%, with 13 years of dividend growth and a 5-year growth rate of the dividend at about 16%. When Home Depot dropped another 7%, I saw it as a buying opportunity, as I expect a rough 2023 for all companies. Thanks for watching. Please like and subscribe. Hope you join me again next week.